Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents that companies don't exactly want you to read closely. It's like they're burying treasure, except the treasure is usually a warning sign. Today we are diving deep into the Madison ETFs Trust Semi-Annual Shareholder Report. Get ready for a thrill ride of bond ETFs, covered calls, and dividend strategies because who doesn't love a bit of financial alphabet soup? This report, covering July through December of 2024, gives us a sneak peek at how these funds are performing and what they're investing in. First up, let's talk about the Madison Aggregate Bond ETF, ticker symbol MAGG. This ETF is all about balance, like a yoga instructor for your portfolio. It aims to give you a broad exposure to the bond market, not just sticking to one type. Let's get to the important stuff, the costs. For every $10,000 you invest, it costs about $20, or if you want to look at it as a percentage, it's around 0.40%. This may seem small, but is something to be aware of. How big is this fund? It's got about $64.5 million in net assets. That's all the money it holds and uses for investment. This fund has investments in 212 different holdings, making it diverse. And the portfolio turnover is at 14%. What does this mean? Basically, it means the fund isn't very active in frequently trading its investments. Now, what's the fund invested in? They're big on mortgage-backed securities, taking up 34% of the whole fund. Then you've got corporate bonds at around 33% and a good chunk in US Treasury securities, about 24%. Looking at the top 10 holdings, the fund is big on the United States Treasury note bond at about 24%. Basically, the US government is a huge part of their investments. This is followed by the Federal National Mortgage Association and Federal Home Loan Mortgage Corp., meaning that a large portion of the investments are in mortgages. Next, we have the Madison Covered Call ETF with the ticker CVRD. What this fund does is use a covered call strategy, meaning it owns stocks and sells call options on them. Think of it like renting out your stocks to earn some extra income. What were the fund costs for the last 6 months? It cost approximately $48 for every $10,000 invested, or 0.93% of your investment. The fund has about $56.8 million in assets and has about 79 holdings in total. It has a pretty high portfolio turnover of 49%. So the strategy they have involves more frequent trading of assets. Looking at investments by sector, technology is a major player at 25%. Followed by healthcare at around 14% and consumer discretionary around 10%. Looking at specific holdings, the Las Vegas Sands Corp and Alphabet Inc., the company that owns Google, top the list. These top 10 are approximately 3.0 to 5.0% of the net assets. Then we have the Madison Dividend Value ETF, or DIVL, focuses on stocks that pay dividends, which are like little cash rewards for being a shareholder. This could be a good choice if you like getting a bit of income from your investments. How about the costs? It costs $34 for every $10,000 invested, or 0.65%. The fund has about $57.9 million in net assets. This ETF is holding around 40 different investments. It has a portfolio turnover of about 26%. Where's the money going? Industrials and financials are big, each taking up 21% of the fund. After that, you have healthcare and energy. Its top holding is BlackRock Inc., followed by Automatic Data Processing Inc. and Honeywell International. BlackRock Inc. takes up around 4.1% of the net assets. Lastly, there's the Madison Short-Term Strategic Income ETF, ticker MSDI. This fund likes to keep things relatively safe, investing in shorter-term debt securities. This could be your pick if you're looking for something a bit less volatile than stocks. How about the cost for this fund? You pay approximately $20 for every $10,000 you invest, or approximately 0.40%. The fund has $66.9 million in net assets, invested in about 108 different holdings. The portfolio turnover is 13%, which means it invests in safe assets and does not trade frequently. This fund has big investments in financial companies, making up 30% of their investments. This is followed by mortgage securities, which takes up approximately 19%. The fund's biggest holding are with the Federal National Mortgage Association, followed by the Federal Home Loan Mortgage Corporation and United States Treasury notes. Now, the semi-annual shareholder reports has all the details on the financials and investments of these exchange-traded funds ETFs. Now to make sense of these Madison ETFs, it's all about balancing risks and rewards, like being a financial acrobat. Let's start with the good. The assets under management show that these funds have some traction with investors. The relatively low expense ratios across MAGG and MSCI are a definite plus, meaning more of your investment stays invested. DIVL's dividend strategy and CVRD's covered call approach offer different income streams, appealing to various investor preferences. The big allocations into high-quality U.S. Treasuries or government debt can be seen as safe, as are mortgage-backed securities, which can be seen as a stable investment. However, there are weaknesses and risks, of course. The relatively smaller assets under management for CVRD and DIVL compared to MAGG and MSCI could be a concern, as smaller funds can be more volatile. The CVRD's covered call strategy caps potential upside, and its higher expense ratio eats into returns. The CVRD's and DIVL's high portfolio turnover also adds transaction costs and potential tax liabilities. Also, there may be interest risks from these assets. Also, the portfolios are heavily weighted to financial institutions, which may amplify risk in case the industry experiences a downturn. Ultimately, Madison ETFs Trust presents a mixed bag. It offers strategies to generate income, but potential investors should weigh the costs, risks, and returns against their individual goals. They should also do their own due diligence before investing in any assets. The heavy investments in the financial industry and large mortgage positions is also something to keep in mind if something were to happen to the housing market. Thanks for tuning in to Corporate Decoder. If you found this deep dive useful, be sure to hit that like button, drop a comment with your thoughts, and subscribe for more financial breakdowns. Until next time.